if you have a limited company, then you having a director's pension is a no-brainer. Like any way that you take money from that company or any other way, if you're taking it as income, you're paying marginal rate income tax, you're paying USC, you're paying PRSI, and that gets higher as your income gets higher. You're paying tax on dividends, you'd be paying capital gains if you're selling the company. The only way you can tax efficiently transfer money from the company to you is through an executive pension.
Hey guys, so the other day I had a conversation with Kevin from thepensionsstore.ie, and he gave me great insights into the differences between what a sole trader, how a sole trader can build wealth, and how a director of his own limited liability company or an employee of a limited liability company can build wealth. And the insights were really good. We went through how two people, both 40 years old, saving for their retirement, how one of them at the age of 60 ends up with $500,000 and one of them ends up with 1.5 million. And it's the sole trader who ends up with $500,000 and the person who is working for a limited company who ends up with 1.5 million. Now there's a lot of assumptions that go along with that, but by and large, the assumptions are the same in terms of the growth. The main differences, I think, are that sole traders aren't allowed to put away as much into their pension scheme as much as limited companies. So they're restricted by like 25% of their earnings, for example, from 40 to 49. Whereas limited companies can save $6,250 per month. What's more is that the money that's diverted away from the taxman earns more money and isn't taxed when it's earning money. So it's a great way to invest. Anyway, it's worth watching the rest of the video, seeing what Kevin has to say. If you have any queries or questions or comments, type it in the comments down below. Other than that, please like and subscribe and enjoy the interview.
So I can kind of run through a comparison here just to show you the difference between somebody who is a sole trader and somebody who's a company director. So look, I guess there's two ways that you can kind of work in Ireland. You're either an employee in a company or a sole trader, in which case you're eligible for personal pension contributions, or you can be a company director. So I guess if you want to kind of retire wealthy in Ireland, it's the employer contributions that you need to be in control of. And certainly, when I'm talking to people who are either setting up as company directors or already have limited companies, I try to discourage the use of the word pension a little bit because it has a lot of negative connotations for a lot of different reasons. For a company director, a director's pension it's simply a tax efficient wealth vehicle. That's actually what it is. So I can kind of run through a comparison here just to show you the difference between somebody who is a sole trader and somebody who's a company director, just in terms of the amount of contributions that can go into a pension fund for them. So if we look at somebody and we just say, okay, a 40-year-old married man and he wants to retire at age 60. So we'll say that in this case, he's self-employed. So he's a sole trader is what I'm describing that as. I would say he's been self-employed for the last 5 years and he's earning 75 grand a year. So he's bringing in 75 grand a year and he's being taxed on all of that. So that's going to be effectively his salary for the year. So we say that he hasn't got any pensions before and he's never started one up before or hasn't been a member in a company scheme before. So he's starting from scratch. So basically, what these are showing here are basically projections. So 530,000 there is essentially what is being said, that if you're contributing at the maximum that you're able to do at this moment in time and nothing else changes between now and when you retire, then you can reasonably expect to retire with 530 grand. The projections that are there are based on a 5% annual growth rate, which is the maximum that you're allowed to quote for. Some people would say that's quite low. Some people would say it's quite high. It all does depend really on the kind of investments that you're looking at. But if you look back at the history of the stock market over the last 120 years, the average inflation adjusted rate of return over that time is just shy of 10% a year. So there's going to be big peaks and troughs in between those, but 5% is what we're allowed to quote for. So if we just look in here, this is essentially how this 530 grand fund will be made up if we were to assume everything is running, in a linear fashion. That this individual, this guy would be paying in 225,000 euro of his own money, essentially. He would attract 150,000 euro worth of tax relief on those contributions. and the 5% investment growth that we're assuming will be contributing that. So what this is
Just-
basically saying,
Just on our tax relief, the €150,000.
yeah.
Where does that come from? It seems like it just comes out of nowhere, magic.
Okay, so I'll actually answer that in here. So this is the maximum contribution rate that a sole trader who's 40 looking to retire at 60 on 75 grand a year can make every month. So he can put in €1,563, and of that he gets tax release of 625. Now what that means is, if he was taking that 1563 as income, then the net amount that he'd be getting would be 938, because this amount here, this 625, will be taken as PAYE.
So what you're saying is, if he's taking 1,563 out of the business, if he took it as pay, he would lose that 625 essentially, and get 938. But if he put it into a pension scheme, it would all go to the pension scheme.
Correct.
Okay.
So these are on personal contributions. Okay, so that 1563 is important to remember, because that's what we'll be comparing it to. So if I go back in again, and I go back in with this guy as a company director, it's just to show you the difference, because the person is a sole trader, or if you're an employee in a company, you have your employee limits, you will always have them, but you will have fairly limited control or influence over the employer allowances or the employer levels. And that's where the big advantage comes in when you own your own company. So if I go back in here, and we take the same guy, so he's a 40-year-old married man who wants to retire at 60. All these points here are relevant. So these aren't just random. So there's a table, there's a formula that runs behind these, and these are the variables that revenue use to determine your maximum funding rate. So I've been a company director, we'll say, for the last 5 years, and the same thing, he's paying himself 75 grand a year.
So here, just to make the point, the only difference between these two people is one is a sole trader and one is a proprietary director of a limited company.
Correct, or is an employee of a limited company,
Or
but
an employee. Okay.
But he has influence over the employer, obviously, because he owns it.
Yeah.
So here's the difference. Now, on the sole trader side, when we were looking at those 4 columns, they were basically just projections saying, okay, well, if you put in X every month and your money grows at 5% every year, then that's the fund that you can reasonably expect to happen. The difference with these is that first one here, the 1.62 million, that's an actual target figure that revenue are saying to this guy. They say, right, based on all the information that you've said so far, and on the salary that you're taking from the company thus far, revenue will allow your company to build an executive pension fund for you of 1,620,000. So that's actually set in stone. And it's essentially a target. It's essentially a target for this guy, but the company can fund a pension fund for him up to that. So
just want to make the point of that. That's
yep.
three times bigger than the sole trader.
Yeah, and you're going to see why in a second. The first one is just, as I said, it's a projection based on contributions at this guy's allowance. What this is say that's what revenue are saying. You can have a fund of 1.62 million. The difference here is, I'm assuming as well, again, that, and we'll come to the important part on the next screen, but again, we're assuming here that if somebody is contributing into a pension fund, that their investments are getting a 5% a year rate of growth. So that will be split down between this, where the business is paying.
The important thing just to highlight is, under both scenarios, the assumptions are the same.
Oh yeah, they are. Yeah,
yes,
absolutely.
Yeah. Okay.
Yeah. So again, looking at that 5% annualized rate of return, the business will be paying 1.1 million, say, and the investment growth will be delivering $500,000. Now, this is where the difference is. You'll really see it. So you remember, when this guy is set up as a sole trader, he can put in 1563 as personal contributions into a pension fund. The difference here is that revenue give an employee in a company, or a director in a company, you get an allowance every month, and that allowance always stays with you. So the difference here, if in terms of building wealth and you're trying to get money out of a company structure, yeah, you can do personal contributions and you can make them out of your salary, or here's the revenue maximum funding rate for this guy. So what this is essentially saying is that revenue are allowing this guy to take €6,750 a month out of his limited company. So it comes out of the company bank account and it goes straight into his executive pension plan. There's no PAYE, there's no USC, PRSI, or BIK, or anything else, and there's no corporation tax for the company on that money either. So
just to clarify that point, it's basically exactly like that pension contribution is exactly like any other company expense. It can be used to deduct your profit and hence reduce your corporation tax liability without you personally incurring tax on it as well. Like obviously, if you paid yourself, that also reduces your corporation tax liability. But you, as a sole trader or as an employee of the company, get taxed on it. In this is not the case. There's no BIK and there's no PAY USC on that contribution.
Yeah, so it's separate to salary. So it's another allowable monthly deduction in the same way that you would be paying for an accountant, or you might be paying for software fees, or light and heat and rent and all the other things. This is one that's coming to you. So it's, as I say, in this case, this guy's earning a gross salary of 6,250 a month. He can also have an executive pension contribution of 6,750 euros a month. So it works. It's a company expense. It's a valid company deduction every month in the same way that anything else will be. But that's the difference in terms of trying to build wealth. This is the end game when you're ultimately trying to be in control of employer contributions. This is what we're talking about. So the guy who's set up as a sole trader does not have any influence over that because A, he's not in a company structure, and B, he can only fund a personal pension. He can only make employee or personal contributions into a personal pension plan. Another really big benefit to these structures is that, as you'll know, for people who are making personal contributions, they have until the 31st of October in any one tax year to make pension contributions for the previous tax year. So when you're a director or when you're an employee in a company, this 6750, that stays constant. Assuming everything else stays constant, that's there. So somebody has an allowance of 6,750 euros a month. Now, they might only set a director's pension up for £1,000 a month or £2,000 a month. So the gap in between there, so if somebody sets up a pension for €1,000 a month, there's an extra 5,750 euros a month of an allowance that's there that's not being used. So that never goes away. Unlike when you're a sole trader or an employee where you're just making personal contributions, the benefits that you're not using accumulate over time, so that you could be in a situation in 5 or 6 years' time where there's now a lot of money in the company, and you can make backdated contributions to effectively buy back all the unused allowances that you haven't used.
So just give us an example there. Let's say I had a company, I've had a limited company, I'm proprietor director, which means I own all the shares, control the company. I've had it for 3 years. I hadn't put a tap into an executive pension scheme and decided to set one up. Are you saying I've got 3 years worth of €6,750 per month? So essentially 36 months times €6,750 that I can now put in all in one go.
Correct.
Cool.
Yeah. So that will be like a big part of what I do will be coming up to company year end. So a lot of people, people are running businesses, so obviously, cash flow is going to be king. So they don't necessarily want to strangle themselves with committing to something, if you like, even though you don't have to commit to it, but they mightn't want to set the bar too high because obviously they'll have other priorities as they're running a business throughout the year. So the busy part of the year is coming up to company year end, where you can essentially just say, I will be talking to my clients to say, look, you're putting in X every month. If you want to make a contribution to max out this year or max out 2020 or 2019 or 2018 or 2017 or however long it goes back, if there's money in the company, there will an allowance be there. There will be an allowance there. They're called special contributions. So you are effectively backdating. So yeah, if somebody has an allowance, I can do the figures for somebody. So if there's a 300 grand allowance there and there happens to be 300 grand sitting in the company and they want to get it out before the end of the company year end, then yeah, they can literally just lump it over straight into a director's pension, and it's perfectly legitimate.
But they would have to have all those years pre-built, sort of back of unused months where this allowance was effectively not used. They couldn't just set up a company 2 years before retirement and throw it all into it.
Well, you would need, so I guess the kind of benchmark for any of these things for somebody who is where this gets really important is that in order for you to, the calculations to allow you to fund towards the maximum, you need to have 10 years salaried service before your retirement age. So for example, if somebody wanted to retire at 60, they would need to have they would need to be set up, operating and trading and running as a limited company by age 50, so that they would have accumulated the 10 years service before they retire. So where these things become problematic are, you might have a guy who's in his early 60s who might kind of suddenly now discover the value of executive pensions and now wants to set up a company. The problem there is that he won't have the 10 years service accumulated by age 70. Now, revenue you can apply to revenue to make a case, to make a case for why you should be allowed to make pension contributions if you haven't done them before, but they are done on a case-by-case basis, and there's no guarantee that anything's going to come out of it. But so 10 years is a very important benchmark. So for any clients that I talk to who are operating as sole traders, or people who are even employees in companies that are thinking of changing career, I always peg age 55 as a bit of a line in the sand, where you say, well, if you are going to do something, then you should really be looking hard at doing it before age 55, so you get those 10 years accumulated service. Does that make sense?
Yeah, that makes sense. So can you give us a scenario? Who is wasting money by not doing this? So like ideally, are we talking about 30-year-olds who are successful in business, 40-year-olds who are successful in business, who have a sole trade maybe, and are looking at ways of building wealth? Is it ideal for them to set up both a limited company and a executive pension scheme to build that wealth tax efficiently?
If you have a limited company, then having a director's pension is a no-brainer. Like any way that you take money from that company, or any other way, if you're taking it as income, you're paying marginal rate income tax, you're paying USC, you're paying PRSI, and that gets higher as your income gets higher. You're paying tax on dividends, you'd be paying capital gains if you're selling the company. The only way you can tax efficiently transfer money from the company to you is through an executive pension. So yeah, anybody who has a limited company should have one. It's the most efficient tool to build wealth in Ireland, and it's purely because of the tax efficiency. There's no tax when the money leaves, there's no tax on you getting receipt of it, and the money in the pension fund grows tax-free as well, which is a huge benefit that's often overlooked. You look at any other kind of investment, gets taxed very regularly, and it is quite high. So you have a 0% tax applied to funds inside of a pension structure. That's another huge benefit. So just those two.
It just sounds like almost too good to be true. Why is revenue doing this or letting this happen, and will it continue to let it happen way into the future? Because if we're talking to 40-year-olds who are watching this right now, let's say, they're thinking, I'm going to retire in 20 to 25 years. Will the rules still be the same? And why is revenue encouraging this?
Okay, so I guess ultimately, the Irish government wants people to have their own personal funds for retirement. So now there is a bit of a threat to these, because there is a pension simplification agenda that the government is all over at the moment. And part of that is that they're looking to declutter the market. So the three products that seem to be in the firing line for this are personal pension plans, personal retirement bonds, and executive pensions. So even if something like that does come in, it's not as if it's going to happen overnight. Like there's usually there'd be a 3 or 4 year lead time in, I'd imagine, if anything was going to be shelved like that.
Yeah.
But essentially, what the model that it's built off is, like, it's built off the civil service model of how much money would it take to give this person 2/3 of their final salary at retirement. That's basically how it's calculated for a director. It's not that way for a sole trader or an employee. Or an ordinary employee. So that's why it's there. The allowances are pretty big, and it's for that reason. You're allowing people to build wealth so that they can replace their own income, and that they're in theory not going to be as much of a drain on the state later on when they're retired. That's essentially it in a nutshell.
Perfect. Thanks for those insights, Kevin.
No worries.
Sounds like the best way of seeing if you want to build wealth, if you have cash in a company and you don't want it to get taxed, and of course, like, even if you're certain trades attract, and even rent income, for example, attracts a closed company surcharge. A closed company is a company that's owned by 5 or fewer people. that you can't just leave the profit sitting there either. It'll attract a closed company surcharge and eventually get whittled down. So
Yeah.
this is a great option. You have a lot of cash, a lot of profit tied up in a company. You're thinking, I want to build wealth. It's a great way to get out of the company without incurring a tax bill for the company or for yourself, by the sounds of it.
Yeah, and there are other ideas for that as well. So it's not purely about pensions at the end of the day. But
Yeah.
once you have a limited company structure, there's a lot of things that you can do. So not everything necessarily needs to be committed to a pension fund, but if there's profits lying around in the company that are effectively being undistributed, that are or can potentially be liable to that closed company surcharge, there are alternatives to that. You know, you can do company investment plans, you can do company savings plans. Essentially, all those closed company surcharges are there because it's not everybody's interest for companies to hoard money. So they want the economy to keep going. So these taxes are there to encourage companies to keep money going and to keep money circulating. So there are a few ways around that. But again, when you have a limited company structure, you're in control of all of that. And these are the kinds of things that you can do.